Good morning, everyone. Happy first day of March. It is March 1st, 2021, and I'm Mark Phillips here with Harvested Financial, here to talk about the markets. So, big rally this morning, lots of things going on in overnight activity. Futures were up a little bit this morning, but they continue to rally even more into the open. So, we see SPY trading 386.37, that's up $6. We had quite a bit of a rout at the end of the day Friday with some heavy sell offs into the close, but bouncing back this morning. All the other indices are up. IWM, Qs, VIX, of course, is down a little bit. And Bitcoin also had a relatively choppy ride over the weekend, traded as low as the 44,000s, but rocketed back up and is now trading a little over 48,000 today. So it is a bright, beautiful Monday morning here in March, and the markets are just a sea of green. So interesting week this week continuing to happen. We're actually seeing a number of different earnings out here this week. We are definitely paying attention to a lot of moves out here in the options markets. And just to give y'all a preview of what we are looking at there, whoops. So I want to look at SPY this week. And it's covered calls. It's Monday. We're talking about those, and because it's just such a great way to buffer a lot of this volatility out here in the market. So remember, a covered call is the ability to sell the upside call against shares that you own to generate cash premiums. So it's a great way to turn some of that upside volatility into actual cash premiums that will buffer your downside. So I have here in this table displayed a couple of the different ways that we can think about parameterizing covered calls, particularly in SPY today. So that's our benchmark indices. Benchmark indices are what make up our model portfolios. For our custom clients, we also offer more specific opportunities in individual names, but you got to sign up to get that. So I want to look at SPY and think about how we can look at a week out, a month out, and 3 months out in terms of some of these covered call opportunities. So like I mentioned, we like to parameterize by delta. So that's that column that indicates the delta. So the delta, good way to think about that is the probability of that call landing in the money at expiration. Not necessarily that it'll touch that level, but that it'll land there at expiration, because ultimately that's what we care about, is where these options land at expiration. So as you think about a week versus a month versus it's not quite 3 months, it's about 80 days out to the May serial expiration there, you can see one thing first off, delta. So when we look at the 50 delta option, one might think that that's at the money. That actually drifts up over time. So in March 8th, that's the 386 strike. April 1st, it's the 387 strike, and May 21st, that's the 388 strike. So that at the money is going to drift up just a little bit. In a way, one way I like to think about that is the risk-free rate of interest. So, overall, we expect the market to drift up by approximately that risk-free rate over time. So that's one of the reasons why delta will drift up over time. As we look out across the 35, 25, and 10 delta options, we get an idea of sort of how far out of the money they are, which is a good way to think about sort of your dollar buffer that you're going to get here. So right now, the dollar buffer on the at the money is usually pretty close to zero. It's zero, $1, $2 compared to the price in May versus the price today. But as we go further out in time, that 10 delta, that 25 delta, that 35 delta buffer is going to increase. So the 1 week out, 25 delta, 25% chance of that landing in the money, you get a $6 buffer, which means if you buy the stock and sell that call between now and 392, you have $6 extra that you can make if your underlying stock goes up, in this case SPY. If you want the 25% chance in April, you get an $11 buffer. So you're going to get gains all the way up to 397 before you forego that by selling the 397 half call. If you look at the 25 delta in May, you get $22 in buffer. So there's a 25% chance that the 408, or the market is pricing that there's a 25% chance that the 408 call will land in the money on May 21st. You would collect $4 for that, and you'd get $22 of potential upside there. So that $4 will cushion your downside, but it also, by selling only the 25 delta as opposed to the out money, you do have quite a bit to run. So thinking about how much you have to run is an important decision to think about with covered calls and how you want to adjust your strategy. Are you bullish and you want to have more room for that stock to run? Or are you going to be a little bit more conservative and sell something a little bit closer to the money to get some of that extra premium? The difference in premium is pretty stark. If you sell the 388 at the money 50 delta call in May, you're going to collect almost $13. compared to if you sell it for a week out, you're only going to collect about $4. So if you sell an at the money further out, you're going to have more downside protection in the form of that $12 of cash that you've got, but you've given up quite a bit of upside. So thinking about all these different things is really important to consider when you're looking at a covered call strategy. Harvested Financial is all about covered calls and the power that they can bring to your portfolio to reduce volatility, to generate income from your holdings, to divest from your holdings. There are all kinds of great ways to use covered calls and to systematically execute them over time. Like I said, this is just the benchmark. For our clients, we do this across all different names, and we're always looking at different opportunities in high vol and low vol environments. So hit the subscribe button. We'll be talking about this every single day on our YouTube channel, on our Twitter at harvested_DAFE. But make sure to check out our website too, because that's where the special stuff is. harvestedfinancial.com. Thanks so much for joining us. Happy Monday.